the right time. Thanks for joining us on Parliament. This is Bloomberg Quint. I'm Harsha Subramaniam.
Good afternoon. I'm Ira Dugal. Let's get you the headlines. Positive momentum continues on Dalal Street. Nifty hovers around the 11,000 mark. Tech Mahindra is the top gainer after reporting strong third quarter earnings.
The government has asked the RBI to transfer all the surplus reserves it held back over the last 2 years, including an interim dividend of 28,000 crore this financial year.
Jubilant Group stocks are trading with cuts of at least 2%, despite the promoters withdrawing a decision to charge a 0.25% corporate brand royalty from its subsidiaries.
And three Nifty companies, Adani Port, JSW Steel and Cipla, will report third quarter numbers today. We'll get to that, but a quick check on how the markets are faring at this juncture. Yatin is here with a closer look.
Good afternoon, Harsha, and of course we are trading quite strong on the markets above the 11,000 mark. And if you look at the advance decline ratio also, it's quite favoring to the advances today. 4 advances for every 1 declining. So the market breadth, has been quite well as far as the Nifty 50 is concerned. However, if you look at it from the broader markets perspective, a lot of damage has happened in trade today. But talking about the gainers on the Nifty 50 index, we have Z, Tech Mahindra after the results. Tata Steel and Grasim, all of these stocks gaining in trade. Tata Steel also is due to report its earnings, and ahead of that, we have seen some good build-up, coming in for that stock. However, on the losing side, we have the stocks like Adani Ports, Dr. Reddy's, as well as Bharti Airtel, which are down and about anywhere between 2% to 1.5%. Among the active stocks to watch out for, Jubilant FoodWorks, and after the royalty controversy yesterday and the final withdrawal, the stock is under pressure because the overhang probably could be there according to market participants. After opening higher in trade, the stock is now trading at near about the day's low. ADAG group stocks continue to remain under pressure. So be it Reliance Communications, Reliance Infra, Reliance Capital, all of these stocks are down in double digits, and probably a few stocks are down in high double digits. High single digits, beg your pardon. And finally, we have also Dish TV, which reported earnings yesterday, and after a yo-yo ride in trade today, we have the stock finally up 8% near the day's high. Of course, the management is confident of increasing its ARPU, and they've also announced a rights issue for one of their subsidiaries worth 3,000 crores.
Yatin, thank you for that. That's the markets for you. But it's going to be the new RBI Governor's first Monetary Policy Committee meeting and rate decision, also the first after the budget. What are the factors at play this time? Ira's here to round it up for us.
This is an interesting Monetary Policy Committee meeting. It's the first under the new governor, Shaktikanta Das. It's also the first in over 20 years under a non-economist governor. The reason I point that out is simply to say that we have an interesting economic dilemma that the MPC will actually be considering this time around. We've got a scenario where headline inflation, which is the MPC's official target, is very soft at 2.2%. It is below the midpoint of 4%, which is the MPC's target, 4% plus minus 2%. So if the MPC were to look at this and look at its forward projections of inflation, which is what determines policy action in an inflation targeting regime, it could be tempted to cut interest rates at least one time. Some economists are expecting that there's room for about 2 rate cuts if you focus on the headline number. The repo rate is currently at 6.5%. There could be a potential for a 25 basis point cut if you focus entirely on the headline number. But RBI watchers will tell you that the central bank very closely watches core inflation, because that is a closure measure of demand in the economy. And that measure, core inflation, has remained elevated through this entire period where headline inflation has been coming down largely because of food prices. So will the MPC actually choose to focus on core inflation and in that case keep interest rates steady? Now, in the previous regime, the answer to that would have been a no-brainer. Yes, they will focus on core inflation, and no, they will not cut rates. But now they have a legal mandate to actually focus on headline inflation. So So they will look at the longer term trends on core inflation and on headline inflation. And the debate here will become a fairly technical one as to whether core inflation will move down and converge towards headline inflation, or will headline inflation move up and converge towards core inflation? Yes, it's a technical debate, but it may be the debate that provides the answer to whether there is easing of monetary policy in the offing or not. Now, just briefly mentioning that JP Morgan came out with a research just this week suggesting that according to them, it will be headline inflation which will move higher and converge towards core inflation. If the MPC takes a similar view, then maybe rate cuts will not be in the offing. That will be the technical economic debate that will be going on in the MPC. But beyond that, of course, they will be focusing on the usual factors as well. What's been happening to oil, what's been happening to the rupee, and what the bond markets are signaling. On the oil and rupee, I think the only thing the MPC will say is that they remain volatile. We saw a sharp uptick, then we saw a sharp downtick, and now we've seen a pickup again. So I think the MPC will have to take note of the fact that these extraneous factors remain quite volatile, and then they'll try and judge again the underlying inflation pressures before they decide on which way to move on interest rates. As far as bond markets are concerned, there is some expectation of an easing in policy that was reflected in the drop in yields that we have seen. But of course, now bond markets are a little bit more focused on the fiscal story, which of course will be an important input into MPC as well, because they will be looking to see whether the flattening out of the fiscal consolidation story will have an impact on inflation down the line, plus the farm support measures announced. Those would also have potentially a direct bearing on inflation. So all of that will get debated at the MPC level. Should there be a cut, perhaps the bond markets will respond positively for a little while and then go back to focusing on the large borrowings that are scheduled from the government in FY20. A final note on what would the rate cycle look like should there be a change. Remember, we've seen two successive rate hikes in 2018. That's taken the repo rate to 6.5%. But it would be a fairly quick turn in the cycle if we see a rate cut this time around. Incidentally, about 8 of 38 economists polled by Bloomberg are suggesting that there would be a rate cut. But even if there is a rate cut, most people expect it to be 1, at most 2. And then, of course, the cycle will progress based on how factors such as oil and food and, of course, the fiscal story plays out. So an interesting meeting, not just because we have a new governor in place, but also because we have some interesting economic dilemmas to counter.
Yeah, thanks for that. We also spoke to a bunch of economists. Listen into what they expect from the policy this time.
If you look at core inflation, which is generally what central bankers look at when they want to look at, what are the inflation dynamics and what are the concerns they might have, that's running at 5.96%, and it's not just running at 5.96%. It has been growing and increasing over the last 3 months. This is core inflation as defined by the RBI minus the transportation element in it. So we call it core. But that is running around 6%, having risen for the last 3 months, and that suggests that the slack in the economy, which again is a result of the lack of investment over the last 5 years, that the slack in the economy is much less than the headline inflation number would suggest, and that the RBI will have a very difficult time, or the MPC, to be fair, will have a very difficult time trying to decide whether or not they should stick to the headline inflation 2% number, which would suggest that inflation is under control and let's reward the world with a rate cut, versus the fact that core inflation has been rising and has been rising relentlessly, and it is way above where it should be, given all the concerns people had about slowing down growth, etc., etc., etc. So none of that has brought down core inflation. I think that's the worrisome part.
I'm calling for a prolonged pause at this point. I'm not calling for a rate cut. But those who are still calling for a rate cut, you can see things from their perspective as well. And the point here is that every single year we've been talking about high pressures from oil, from droughts, from fiscal slippage, from state deficits, and yet inflation has been stubbornly low over the last couple of years. So there's obviously something in the nature of inflation that is changing, and I just don't think it's India. I think it's a global phenomenon at this point. So of course there are a lot of risks out there, but the truth is that there have been many risks around for many years which don't seem to have been materializing. So I see what people who are calling for a rate cut are arguing. And yet, because I find that core inflation is so elevated, and I find that the details of the fiscal are showing that it is a little expansionary, I'm still sticking to my prolonged pause.
There is no denying that I think rate cuts are needed. But from the perspective of what they will do, that's when you have to bring in more sort of variables into the picture. The most important thing is that if you're on a tightening bias, if you end up cutting rates, then you are pretty much telling the market that for all of the coming 5 years till the time that this vintage of economists and analysts and market traders are around, no one is going to believe you when you say, oh, we are going to a tightening bias. So what's the meaning of a tightening bias if you are going to cut rates when you're in a tightening bias, right? So I think the first step has to be to clear the way and move to neutral or an easing bias, and at least acknowledge that there is a growth problem. And then if the inflation stays where it is, then you cut in April. I think that's a more sensible way of doing it.
The MPC is late, both in shifting its stance to neutral and in cutting rates. To be fair, don't forget, the MPC had actually raised rates twice before changing its stance, right? And that is simply because some of these things are evolutionary, the way some of the risks were presenting at that time. I don't think they could really look far ahead and signal a change in stance and also raise rates at the time. So they did it incrementally. It just so happens it landed up being twice, and then they shifted their stance. There's no reason why the stance can't be changed and a rate cut be announced at the same time. I mean, there's no rule book that says that can't be done. In fact, I would have argued that they should have shifted stance at the last meeting. It is important to emphasize, I don't think there's any strong case, or actually even a weak case, for an aggressive easing. My sense still remains, and it's a non-consensus view I've had for some time, that there will be 2 rate cuts. And that pretty much justifies they can be on a neutral setting and still be able to come through with those.
Well, I think they need to cut rates now, but if the postponement or the delay in a rate cut is justified by the fact that they need to change their stance and then wait and watch, which is a popular phrase these days, and then cut rates, I think we might just miss the bus or boat, whatever the expression is. So I think they should both change the stance and cut the rate in February, and I have a feeling they will this time.
All right, the MPC debate. Let's move on to another story pertaining to the Reserve Bank of India. It turns out that the government is asking the Reserve Bank of India to transfer some surplus money which it had put in its reserves in FY17 and in FY18. The government expects that those 2 transfers would be part of the large 29,000 crore interim dividend that the RBI is expecting to give to the Finance Ministry. This is important because it's coming even before a committee headed by Dr. Bimal Jalan submits its report. Nikunj Johri reports.
The government has asked RBI to transfer the surplus it has withheld in financial years 2016-17 and 2017-18, Junior Finance Minister informed the Parliament. The government has requested RBI to transfer an interim dividend in financial year 2018-19, keeping under consideration the surplus which was withheld by the RBI in FY17 and FY18. Remember, the RBI had transferred 131 billion rupees in its contingency fund in FY17 and about 142 billion rupees in FY18. Now the government is asking the RBI to transfer this amount to the government in 2 tranches, Bloomberg News reported. The government in its budget estimates has considered this 13,000 crore rupees it is going to get from the RBI in current financial year, taking the total RBI surplus that it's going to receive to 68,000 crore rupees. And for the next financial year, the government expects 69,000 rupees to come from the RBI as surplus, which includes 142 billion rupees that the RBI transferred to its contingency fund in FY18. This comes after the RBI agreed to constitute a committee to look into the surplus that the RBI should hold on to its books, and the committee is yet to submit its report. And even then, the government has decided to ask RBI to transfer the surplus it hold on to its books to transfer to the central government. Over to you.
Thanks for that. Let's move on. Jubilant FoodWorks and Life Sciences are both down in trade today, despite the promoter withdrawing its proposal to charge royalty from Jubilant FoodWorks, which of course runs the Domino's chain in India. Neeraj is here to explain what really is going on, and despite the clarification, there still seems to be some concern.
Yeah, I mean, yesterday the common joke was that are people ordering from Domino's because of the name Jubilant or because of the name Domino's? But yeah, I mean, so the news is now well known, right, guys, that they went ahead with what they thought would get passed without any hitches. And I think immediately post-evening, and I have first-hand confirmation out here that immediately post-evening, shareholders and sell side both were up in arms against this move, believing that this would lead to sharp carnage in the stock. So to be fair, CNBC broke this news yesterday, a version of this news at around market hours, and the stock had already reacted after closing slightly higher. The formal announcement came out, to which all of this was there, and the company then backtracked. Now the issue out here is that while the promoters in Jubilant FoodWorks own 45%, nearly 45%, and in Jubilant Life own 50%, the institutional shareholding is extremely high. So in the case of Jubilant FoodWorks, sorry, but if you can go back to the chart, in case of Jubilant FoodWorks, you will see that 39.41 is FI held, 6.73% is domestic mutual funds. So low liquidity and nearly 45%, as much as the promoters own, the institutional shareholders hold as well. And sources that I spoke to personally on the institution side, of course not on the FPI side but on the domestic AMC side, mentioned that they collectively urged the promoters to reconsider the move that they've done because it would have led to carnage on the stock today, in their own words. Presumably this would have worked, and which is why the move was taken back. But in effect it shows the overhang of this intent of the promoter would have remained. And while in the pre-open session the stocks did start off in the green and leading people to believe that, okay, you know, the fact that the promoters have taken the step back as opposed to some of the others who don't even take the step back, is this a positive? But at that point of time also we commented that was not the case. And to the technical factors as well, guys, that yesterday people might have believed that there were a lot of shorts piled up on the stock, but that wasn't the case. It was merely long unwinding that happened because Jubilant had already approached this move with a fair degree of optimism. So yesterday there was some bit of long unwinding that happened. So no shorts in the system to aid any kind of short covering as well. So not surprised, frankly, that it is down despite the promoters withdrawing the move.
All right, Neeraj, thanks so much for that. Let's move on. Hindalco's US-based subsidiary Novelis reported a mixed bag of earnings in the December quarter. Profits slumped more than 30%, even as adjusted EBITDA showed a marginal improvement. Is this a symptom of a global demand conditions? Nikki Mirchandani is standing by with the analysis. Nikki.
Hi, for Novelis, good set of numbers reported by the company, even as the profitability slipped for the company, 35% downtick. But then the numbers were pretty much wrong. For Q3, the EBITDA per ton was almost around the $400 per ton level. The good part was that the management suggested that it plans to sustain that kind of level. This is the kind of the margins that the company is expecting despite the growing headwinds in terms of the input cost pressures. And resounding the same thing, pretty much brokerages maintained the buy rating on the counter and suggested that the outlook right now for Hindalco looks robust, given that Novelis subsidiary has reported good set of numbers. Edelweiss, however, tweaked the estimate a little bit and suggested that they estimate the EBITDA per ton performance to be a little lower than what the management has guided, to the tune of around $400 per ton. Having said that, they still have a target price on Hindalco which is almost 30% higher than the current market price.
Okay, thanks for that, Nikki. You're also tracking JSW at the juncture. Tell us what's the market anticipating this time?
So now the stock is currently trading at day's high point, 1.5% uptick that we're looking at for JSW Steel year-on-year basis. Good set of numbers. Sequentially, however, we might just see a dip coming in on account of the sliding steel prices and the raw material cost escalation or the pressures which might just be felt across the margins. Basic numbers first. Top line, we're looking at 18% growth out there. EBITDA margin of 14. EBITDA performance is expected to be a 14% uptick. Their margins are expected to be around that 21-22% kind of level, percolating down on the muted set of bottom line performance, which is going to be a number which is closely around 1,700 kind of a level. Importantly, three factors that we like to keep an eye out, or essentially the matrix that we'd keep an eye out for JSW Steel, will be the volume figure of 4MT, the EBITDA per ton of around 11,000, and the EBITDA realization, which is expected to be a northward figure of around 52,000. That's essentially because of the higher steel prices and volumes are expected to aid the operational performance of the company, at least year-on-year basis. But then in terms of commentary, what we'd like to hear out would be the steel price hike, if any, coming in from the management, because the steel prices now are currently floating around that year low level. Apart from that, we'd be looking at any demand scenario, steel demand scenario, and obviously the escalating cost pressures, given that coking coal prices are now at 1-year high, while that of iron ore are near a 2-year high.
Nikki, thanks so much for that. Cipla's revenue is expected to hit a 5-quarter high, but that may come along with a dent in margins. Darshan Mehta joins us with the analyst expectations. Darshan.
Yeah, so it's not been a very, very good quarter, at least for companies in the pharma space. If you're looking at Cipla, also a modest 5% growth on the top line, but an 8% decline both on the EBITDA terms as well as profit terms. Mainly what has happened is certain products were launched and that will aid the revenue. But apart from it, except for US, the other markets look rather weak. The tender business is seeing a lot of pressure at this point of time, and that probably will impact the numbers of the company. There is delayed onset of the acute respiratory season that may affect the India business for the company. They have had supply chain issues for the past few quarters that also may crop up. And finally, decline in Yemen as well as Iran sales may be affected because of the US sanctions. What do you watch out for? What's the US sales guidance? What's the guidance as far as the tender business revival is concerned? And finally, what is the resolution plan for the business challenges that they face, especially in terms of supply chain?
We're also looking at Lupin. Darshan, similar pricing pressures in the US for Lupin as well?
Yeah, similar, because if you're looking at the top line, a 3% growth, but the EBITDA will be down 7%. Profit will be higher because of other income, which is because of a one-off that we are expecting this time around. Back of competition and price erosion in some of the key drugs is something that will dent the top line of the company. There are lack of launch of new drugs that are there. US sales, we're expecting a 7 to 8% quarter-on-quarter increase that will come in. But nevertheless, Tamiflu seasonality and metformin volumes will aid the sequential growth. India business, we are expecting a modest 10% growth this time around. What we are watching out, what's the update on the warning letter resolution, and what's the FY19 US sales guidance? That's something that we want to watch out for Lupin.
Darshan, thanks so much for that. Power distribution companies may have to pay in advance for the electricity they purchase. Government is considering a proposal for prepaid power in a bid to ease the financial stress on power generators. Rajesh Kumar Singh of Bloomberg News joins us with the details. Rajesh, what have you picked up on this proposal?
Yeah, so the thing is that the Power Ministry has heard representations from the power generators for a long time, who have said that delayed payments from DISCOMs are causing difficulties for them, and which is stressing their working capital cycle and kind of curtailing their ability to repay debt. This proposal has come in the wake of that challenge. Now the idea is that let's say the coal-based generators, which account for about more than 70% of our total generation, they buy coal by paying upfront money, and the Power Ministry has also floated a proposal and asked all the DISCOMs to move to prepaid smart meters in a period of 3 years. So the front end and the back end is going to be prepaid. The middle portion of the supply chain, which is where the generators sell electricity to DISCOMs, that is where the problem is. And this is an effort to, if this is also made prepaid, then the entire supply chain in the power system becomes prepaid, and it will ease the working capital cycles for all of them.
Rajesh, thank you for joining us with those details. That's the situation in the power sector. President Donald Trump called the United States the hottest in the world in his State of the Union address, but he did point out to several global risks. Bloomberg's Kevin Shirili lists out the big highlights in this report.
The president trying to strike a more uplifting tone on the issues of combating childhood cancer from a domestic standpoint, as well as on issues of health care. There is a nonpartisan path forward to get some legislative fixes in the health care legislation. But then on foreign policy, whether it was denouncing dictator Maduro and announcing support for interim Venezuelan President Juan Guaido, but also on the issue of trade policy, the president asking Congress to make legislation pass and advance through the Congress that would make it more difficult for countries like China to impose increased tariffs. He said that he wanted to continue to work with China as well as other nations on the issue of North Korea. Now, all All of this comes, of course, during the trade tensions between the U.S. and China. And President Trump really making a case now to the populist streak in American politics to try to get support within the halls of Congress. Whether I talk to Democrats or Republicans, there does seem to be some consensus on the issue of combating China on issues relating to intellectual property. So it will be interesting to see just whether or not the president's ask of Congress to pass legislation to address the issue of tariffs does advance.
Out of time on the show. Thank you so much for joining us today.
Lots more coming up.
RP Sanjeev Goenka Group, growing legacies.